Hello, everyone. So it's a pleasure to moderate this distinguished panel on private equity in Africa, powering economic recovery. So we will explore how private equity investments are pivotal in fostering economic growth, innovation, and resilience across the African continent. Our discussion will cover recent insights on private equity trends, including exits, fundraisings, value creation, and impact investing, which are increasingly vital for the African context. So we extend our sincere gratitude to AFSIC for hosting us and to the panelists for their participation. So let me briefly introduce our panelists. So today we have Maria Angeles Leon, co-founder and president of Global Social Impact Investments, an impact investment fund manager, which contributes to improving the livelihood of people in vulnerable situations. Then we have Gebengna Hassan, managing partner at Argentil Capital Management, who brings over 20 years of experience in private equity and principal investing in international and West African markets. Next, we have Nirmi Glenn Ening, Director of Corporate Finance at Numeral, a diversified group listed on the Johannesburg Stock Exchange and managing investments across various portfolios. Then we have Imed Nasrallah-Din. If my pronunciation is not good, please tell me. So Imed is an associate director at the European Bank for Reconstruction and Development, EBRD, advising on integrity and reputation risk. And finally, we have Jared Gilmer, an experienced investment specialist and certified financial planner, currently leveraging his expertise as group CEO of Everest Wealth, a South African-based wealth management firm specializing in alternative investments. So let us begin our discussion. So first, I would like to emphasize the key role that private equity plays in Africa's economic recovery. And we will examine this by questioning our panelists based on their areas and regions of expertise. I actually would like to start with Mr. Gebengna. So given your extensive experience in West African markets, can you share your thoughts on the challenges and opportunities for SMEs in regions' economic recovery through private equity investments?
Thanks. Thank you very much. I think I'll start with opportunities rather than challenges. And then I'll go to the challenges. So in terms of the key opportunities for SMEs, one, you're serving underserved markets. So basically, there is significant demand and limited supply. So there's strong opportunities for businesses who are well positioned to take advantage of that. We're also seeing digital transformation. So the way products and services are delivered have moved from the traditional way, and that is with improvement in technology, that has meant that you're able to deliver hopefully cheaper and quicker. And then, you're seeing more resilience. What COVID taught us on the African continent was it's very important to look out and be able to ensure that you're able to be self-sufficient to some extent, right? Not relying on imports. So you've seen a strong situation where a lot of SMEs have become more resilient in terms of developing their supply chains and also delivering products that perhaps were relied on imports pre-COVID. On the challenges, I think the challenges have been talked around. The macros are tough. In Anglophone West Africa, where we invest in, you've had significant high inflation and devaluation in currencies. So that's provided challenges. There's limited capital. I think the last panel touched on that. There's limited capital that goes into SMEs. So the available capital that goes in has to be deployed judiciously such that you can get returns to investors. I think I'll stop there and let the other panelists.
Great. Now, thank you, Gebegna, for these insightful thoughts. So now shifting our focus to Maria Angeles. Private equity also plays a key role in strengthening SMEs. So how critical do you think this financial support and technical assistance, how critical are these in helping SMEs build capacity, improve operations, and maximize business outcomes?
Yeah, so from our experience, there is a huge demand for technical assistance in getting ready for investment. Companies sometimes are not, financials are not very clear, audited accounts are mixed, so they need technical assistance to get ready for investment to start. So once you're invested in a company, what we normally do is try to grow their market, because we always think the best investor is a customer. So we also use these technical assistance funds to try them to grow the market they're serving and their revenues. Third, which is very important in a social impact fund, is impact measurement. And now this impact has been like very important everywhere, because you know the European regulation is getting crazy about so many things. They are asking companies that are producing agricultural products mainly to be able to be imported by Europe. So this is such a huge burden in companies that are just starting to grow and want to scale, that I think we need to pay it out of the investor return. So this technical assistance would also be deployed in impact measurement and help companies comply with all the regulations they need to export their produce.
Right. Sure. Yeah. Thank you, Maria. So, Ahmed, picking on you. So, speaking about technical assistance, how does EBRD, as a DFI, integrate technical assistance into its investments and risk strategy to ensure the success of the projects in North Africa, where you are focusing on as of today?
Thank you very much. I would like to start by saying, first of all, that the EBRD is a development finance institution that invests in 36 economies across 3 continents, including, as you said, Najwa, in North Africa, where we are active in Tunisia, Morocco, and in Egypt. The bank's mission is to help its countries of operation transition towards sustainable and open market economies. And one of the ways we do that is by developing the private sector in these countries, and also by ensuring that we assess all of our investments against what we internally call at the EBRD the 6 transition qualities to help our countries of operation become more integrated, more greener, and well-governed. I mention well-governed as well because I work in the EBRD's Office of the Chief Compliance Officer, where we deploy technical assistance throughout our investments to not only assess our projects in terms of what reputational and integrity risk they pose to the bank, but also to help identify opportunities for EBRD's clients to enhance their systems and controls. For instance, one of the tools we use is what we call anti-corruption action plans. So when we look at a potential new client and we see, for instance, that they do not have sufficient controls to mitigate the risks that they face, we would use technical assistance through these anti-corruption action plans. We have numerous examples where we've done this before in the region. And where, in Egypt, for instance, we worked very closely with a state-owned electricity company, EEHC, which was the first SOE in Egypt to develop an anti-corruption action plan and establish a compliance function with the support of the EBRD.
All right. And then I understand that, EBRD are now expanding into sub-Saharan Africa, some specific countries.
Correct.
So what are your expectations as EBRD develop into those
Absolutely.
markets?
So in 2023, the EBRD's board of directors took a decision to expand the EBRD's operation in an incremental and limited manner into sub-Saharan Africa. So initially we're talking about 6 countries where we are expecting to start operating in 2025. These are Ghana, Nigeria, Kenya, Cote d'Ivoire, Benin, and Senegal. Similar to what we currently do with our equity funds projects, we have very stringent requirements when it comes to ESG, when it comes to integrity due diligence that are pretty much baked into our investments that fund managers have to adhere to as part of EBRD's financing. So we would expect to align them to match also the risks that we think are going to encounter when we expand to sub-Saharan Africa.
Okay, great, thank you on that. So Glenn, so considering this perspective and given your experience and understand it in corporate finance, private equity, private debt, how do you plan on supporting and structuring well, not only your clients, but also your portfolio companies within Numeral? You can tell us a bit more, and specifically, as I understand it, in Southern Africa, right?
Yeah, it's actually all of Africa.
Okay.
Yeah, we predominantly have a focus on Southern Africa at the moment, just because we're geographically situated in South Africa. But yeah, Najwa, thank you for that. So, interestingly, we've got portfolio companies, as you mentioned, but we also advise. So, clients, SMMEs would come to us for capital. Typically, that's where they start, looking for capital. Most often, it's equity. We're typically finding that in the value stack or on the balance sheet, the biggest gap across Southern Africa is the equity component. And we would start by understanding their business, understand what their growth aspirations are, and what type of capital would best suit them across the debt spectrum and from an equity perspective. Some of those clients would start off as potentially as clients. We would assess it from a fundamentals perspective, and if the business is scalable globally, has a niche value proposition, strong fundamentals, we may put the equity in ourselves, or we could syndicate with, we could bring other equity investors on board, and same on the debt. So we can structure the debt, do our own private debt investment into those, or we could syndicate with other debt players to optimize the funding solution for the SMMEs. But we don't actually stop there. So very often when they come to us, they don't realize everything else that we can provide to them. And then they discover that through the journey with us. So we provide a full shared services function to them, which includes mine and my team's services from a corporate finance perspective on the capital raising and structuring and general mergers and acquisitions advisory. But then they get access to a fully fledged marketing, through-the-line marketing agency. We give them those services. They get strong technical support from our IT department. So our IT team has got 8 developers on board, and we can help our investees build apps, build websites, all the way through to the back-end development, whatever it is that they require to make their businesses more efficient, enhance distribution, or reduce cost, or improve the customer value proposition that they're presenting to the market. We offer... Okay.
Not us.
Don't worry.
We offer HR services, accounting services, and legal services to our investees to empower them, improve their operational efficiency, and let them focus on what they're good at, so what their actual business model is, rather than when they're small and nascent on the S-curve, having to focus on all of those other things that they typically wouldn't actually have the capital for or the expertise for, yeah.
And is there a typical size that you're looking at in terms of debt equity mix that you spoke about?
So every single opportunity is unique. And from an equity perspective, we've looked at opportunities deploying as little as R1 million into an opportunity, yeah. And where it gets larger, so if you start looking at the tens or hundreds of millions, we would bring in other investors. So we'd bring in other equity investors, and we would provide a structured capital solution or funding solution that included equity and debt.
Okay,
Yeah.
great. No, thank you for detailing your plans so thoroughly. So as we explore the various growth approaches within the investment landscape, I would like to turn to Jared. So Jared, as the CEO of Everest Wealth, how do you differentiate your approach to drive performance from traditional private equity, particularly given your focus, as we discussed, on retail clients and a diversified asset allocation?
Sure. No, thank you for the question. And I kind of think back at 8 years ago when we started our business, whether that was the right decision or not, because traditional private equity focusing on really high growth opportunities for family offices, for pension funds, for institutional investors, and we decided to be slightly different, saying that ultimately you've got this link in the SMME space. Small and medium businesses, ultimately the people that are going to utilize and adopt those businesses, why can't they be the investors themselves? And we kind of said the biggest market globally is the retail market. And, you know, if I play the movie 8 years forward, we learned a few interesting lessons that retail clients think differently, they behave in a different way, they expect different things from investments. And kind of that led into our investment methodology and investment thesis, which was to be very agnostic. You know, we're not sectoral driven or specific asset driven. We have a blend of private equity, private credit, even venture capital. It's all based on the actual opportunities that present themselves. And quite interestingly, if you're agnostic, you get a natural diversity. So you start to do small to medium ticket sizes, you kind of get a portfolio of assets that are multi-jurisdictional, you know, various sizes and also in various sectors. And you kind of get this non-correlation between assets that I think perform really well for investors. And in the end of the day, my view on private equity, any business is three core elements. You're looking at profitability, cash flow, and value. And ultimately, traditional private equity focuses mainly on the value component, which is integral. But for retail investors, the yield, the profitability, and the cash flow, I think is more preferential in their everyday lives from an investment perspective.
Okay, thank you, Jared. So after discussing the critical role of private equity in supporting SMEs, I think it's essential to explore the strategies that can enhance the effectiveness of these investments, particularly the innovative blended finance strategies that are gaining traction across the continents. Maria Angels, I know this is a topic that which is important for you, so building on this topic of blended finance and given your work on Africa-focused impact funds, how do you blend private equity and debt to enhance the growth and sustainability of African SMEs?
Yeah. Okay. In this question, first, we normally do more private debt than equity because it's very difficult to find a secondary market in Africa for the kind of projects we're doing that are mainly working with vulnerable communities in agriculture. So this being said, the way we blend is because we want different kind of investors in our fund. So in our fund, we have a tranche that is a guarantee on our portfolio that is coming from Europe. So I think it's very clever for DFIs to put their money, that they are not putting any money, just a guarantee, to wait how the fund is going to perform. In our case, it is 20% of the portfolio. I think it's a lot. I mean, we are not needing that. But private investors feel very comfortable knowing that there is someone paying for this first 20% of losses. There are other ways to do it, and the Green Climate Fund, which is a nightmare to deal with, is doing very well. That it's getting into the fund in a junior position. So they can go up to 50% of the fund, being able to absorb all these 50% as an early stage loss. So this kind of blended finance, I think, are being able to unlock loads of private capital, which is just de-risking what the private investors think about Africa, especially in Spain. I don't know, maybe here, but yeah. So if you tell them that part of the money they're investing is guaranteed, and then you are promising them on top of that 5, 8, 10% return yearly, I think it's a really good bet. But we still need the help of DFIs, but not just they pouring the money themselves in the countries, but helping to unlock other private pockets to invest in Africa.
No, thank you. So Imed, you're DFI. So in this context of blended finance, what best practices does EBRD, for example, follow to make informed private equity decisions? And what can you add to what just Maria Angel said?
Yeah, I suppose beyond sound banking principles that apply to all of the EBRD's private equity fund investment decisions, there are, I would say, three key areas that we focus on to make these decisions. The first one is really utilizing the EBRD's unique modus operandi when it comes to our local presence on the ground in all the countries that we work in. So in all of our countries of operation, we have resident offices where we have locally hired staff that bring in the knowledge of the market, the knowledge of the risks and the opportunities in these countries. And we rely on that quite a lot in our investment, and we expect to continue to rely on that as we expand to sub-Saharan Africa. Of course, we also rely on the networks we have with other DFIs and other international financial institutions that are active in the countries that we're expanding to. In addition to that, I would say the EBRD, beyond bringing or focusing on financial additionality as part of its all private equity investments, we also focus a lot on impact. What impact additionality can our projects bring? And as part and parcel of that, we focus on ensuring that sustainable development goals are baked into our investments. So focusing on the sectors that are relevant for the EBRD to develop, focusing on the key areas where we can contribute to the development of our countries of operation, such as moving towards green economy transition, financial inclusion, and gender equality. And I would say the third main area that is very important for us is the due diligence that we do, coming from also compliance. We have a lot of robust due diligence practices in place. Beyond the financial due diligence that our bankers do, they do a lot of due diligence on the environmental and social governance aspects, but also on integrity due diligence in order to understand, for instance, for private equity firms, the fund structure, who are the other investors, the other LPs that are coming in, and what are the key risks that we need to understand and mitigate.
No, great, thank you. Jared, picking up on what Ima just explained from a DFI perspective and given your client's profile that we spoke about earlier. So in your case, how do you actually integrate both impact investing and economic returns into your overall investment strategy? And also I'm interested to know, how does this compare to, because you invest also internationally and in Africa, how does this compare to international markets versus Africa?
Sure. Look, I think local markets, when I say local in Africa as well as international, a fund manager's job, investment manager, investment bank, it's not always easy. And I think it's because we all live in this global economy and we all want to make an impact. We believe in ESG, we want a better world to live in, but ultimately you have investors looking at you to generate a return. And sometimes we have a robust deal forum where many opportunities are presented and you kind of feel like it has to be a trade-off. Fortunately, as I explained in our portfolio, naturally this diversity we developed, I feel, if I can use the analogy, you can give someone a fish, give a man a fish, but you teach someone to fish. And because we've linked that balance of retail investors ultimately being the ones that adopt the businesses, we find that we naturally don't have to have that trade-off. You kind of have businesses in Africa, which is the youngest population globally. You have an entrepreneurial spirit, you have an innovative spirit, you have perfect opportunity to deploy expansion capital. And that's something that we're quite passionate about. And if you do that right, you kind of, as my colleagues illustrated, become a support mechanism for these SMMEs instead of just a capital market exercise for them. So from a return perspective, certainly Africa has its challenges, but what we've identified is that the value ship, and if you're willing to put the long-term effort in with these SMMEs, Africa certainly has a lot of value to give.
Great, no, thank you, and glad to know that Africa versus I guess you have 60% right within Africa for your investment, and you are still looking to grow.
ultimately always looking to grow. And maybe just to add to that, in our business, we don't just look at where we deploy capital in terms of jurisdictionally, we also look at the businesses we invest into and where their offset is, and the businesses that they will further do business with. So I'd like to think half of our portfolios are already internationally exposed, but we believe in SMMEs in Africa being the starting place. It's the culture, it's the way of doing business that quite excites us.
No, great, thank you. So Glenn, well, you're also in South Africa, so how does Numeror Group, what is your approach for capital deployment to maximize, again, social and investments and economic investment impact?
Okay, thanks, Najwa. So we do have a dual mandate when we are considering capital deployment.
Okay.
I've sat around the boardroom table and listened to the passion with which it's debated the social impact that our investments would make on investments. So we take that part of it very seriously. Financial inclusion is very important to us. We do have a very strong fintech element to our portfolio, and which I'm going to come back to. And our investments, it has to make financial sense, obviously. So it has to meet our ROI targets. We have to generate the required return for our investors. Very similar to what Jared was saying.
Mm-hmm.
So I lost my train of thought. Yes, that's it. Thanks.
Okay.
Yeah.
No, thank you. Thank you, Glenn. And now I would like to shift to focus to exit strategies. So Gebenga, what strategies have you found most effective in West Africa, which is obviously well, a growing market for private equity, but well, I guess less than East Africa. If you can just tell us more about the exit strategies that were successful in that part of the continent.
No, thanks. But I think before I get into that, I think I'll just, because I was reading, there's a screen there, so I was reading the topic again, private equity in Africa, power and economic recovery. Yeah. And I think just for plug for private equity for us in the field, I think it's a very important strategic tool to power economic recovery. And why do I say that? I think a lot of the headlines that you see are ex-DFI investing X millions into a bank. And when I see that, I laugh because I say, how is that money going to get deployed to an SME? Banks are not structured to deploy money to SMEs. So you have a situation where I think one of the best tools to get money to SMEs is private equity, right? And why do I say that? So coming to your point around exits, one of the reasons why we got into investing in companies was there was an SME that approached us. They needed $1 million. They came to our investment banking guys and said, can you help us raise $1 million? The investment banking guy said, by the time I work out my fees, it doesn't make sense, right? So we said, okay, let's look at it. Mm-hmm. We looked at it. We backed the company. They provided vessels into the marine space. They wanted to acquire a vessel. If the guy went to his bank, the bank will ask him for security that is worth more than the vessel, his mother's name, and all their properties. We gave him 3 rounds of funding. He bought 4 vessels. He expanded from Nigeria to Togo, Benin, Ghana. Today, he's doing $15 million in revenue. He's moved into my building. He's probably more successful than I am, right? So that, for me, is the beauty of private equity, right? That you can look at a business, not take a traditional lens of just putting in with all the collateral that a bank would need. And for us, we've been able to demonstrate that we've put in capital into him.
Yeah, you can create
He's
the
returned that capital. We've returned it to our investors. To date, we've invested in 16 investments, where we have one close to closing, so that's why it's close to 17. And we've had 7 exits. And why have we done that? Whenever we look at an investment, we're quite strategic as to how are we going to exit this investment. Even if the opportunity is great, if we don't have a path in our mind on who is a potential buyer, or we can't structure a structured exit, chances are that we wouldn't do that investment. And that for us is pretty key, because one of the things that we're currently looking to do is back strong, resilient management teams. As I said, our markets are challenging. In Nigeria, you've had devaluation of about 4x between 2019 to date. Ghana, you've had a devaluation and a currency and a debt issue. So you need to back businesses that have strong, resilient management teams, and essentially through that are able to generate returns that essentially will attract a strategic investor. For us, the strategics and potentially the financial investors remain the key exits. IPOs are very limited in our market. So what we also do as we've invested into a business is start to engage potential exit opportunities early. So from the time we put an investment in, we're either speaking to a larger investor to co-invest or to look at the opportunity, or we're getting the business to partner with a strategic, such that when the time is right to exit, the strategic understands that business. So for us, what we try and do all through the process is, one, look at where's potential exit, structure something where we don't think there is a potential liquidity event through a traditional sale. So when I say structure something, that may be a recapitalization of the business to take out cash. But then, like I say, work with potential exit players that we see through the process, such that by the time where the business is positioned, it's not new. They know the business already, they know the management, and they're comfortable.
No, great. No, thank you for these insights on value creations, I would say, and exit strategies. I would like to, before turning to the audience, I just would like to turn our attention to the particular sectors where private equity is making a significant impact. So let's discuss briefly how investments in specific sectors such as agriculture, agribusiness, renewable energy, and technology are driving economic growth and social change across the continent. So a question for all the panelists. Looking ahead, private equity will surely continue to be pivotal in shaping Africa's economic landscape. So if you can just, each of you briefly tell me, what does the future hold, and how can private equity adapt to Africa's specific evolving sectors, from agriculture and infrastructure to digital innovation and green energy. So I would ask each of you to just give me concrete examples or initiatives based on his own experience. So maybe we can start by you, Glenn.
So in terms of investing in infrastructure, the closest in our portfolio would be our healthcare infrastructure, particularly in the biotech space. So we've already started investing in stem cell technology. We've invested in a stem cell bank and stem cell processing laboratories in South Africa. There's only two players that presently offer that opportunity to the market in South Africa. So it becomes structurally important for the nation, for a country. To be investing that, and you're only going to see that type of investment really coming from private equity spearheading it. First, understanding the risks, understanding what the potential risk profile could be, understanding how to scale businesses like that, and potentially looking to the future to vertical integration for margin enhancement, or whatever may be required for a nascent industry like that to succeed. So, just as an example, when we first made those investments, we knew what we wanted to do several years later, but we first had to lay the groundwork, investing in the laboratories, getting the right people on board, forming the right relationships with doctors in the market, and then we pursued what we had set out in the original investment decision, we pursued several years later when we invested in Vitalize, which is a clinic. It's clinic infrastructure, utilizing the service in the longevity and wellness side of the stem cell industry, as well as in stem tech, which treats diseases. So utilizing stem cell technology. So we work with doctors to extract adipose tissue from patients. We process it in our laboratory. We extract the mesenchymal stem cells from the adipose tissue, and then we send that back to the doctor, who applies it in a myriad of treatments for patients that they otherwise would never have access to.
Yeah.
But this is the type of future medical infrastructure that we actually need in the countries. So just to bring it back, it's private equity that's spearheading that type of investment, understanding how to generate a return out of it while doing social good.
Great. No, thank you. Very, very interesting example. Mariangel?
Yeah. So for us, as we are mainly focused in agriculture, and I find similarities with Spain, Charlie was saying in the panel before that England has been the slowest developing country until they get developed. In Spain, it happens the other way around. So my grandparents, both of them were working during the day and studying at night. And I've studied in Spain, my full degree, and my children are studying abroad. So it's just 2-3 generations where Spain has been able to develop. So compared with the countries we are investing in Africa and doing agriculture, the path we are following is these companies need to grow, whether they can join forces with other and do M&A or whatever, because they grow, because they scale, and then start growing up in the value-added chain. So for a sesame seed cooperative, we want to build a sesame oil factory. And for a maize cooperative, we would like to have maize flour to be built. So that's what we are trying to build, but everything needs time, and private equity and capital markets don't have the patience enough to see how things grow.
Thank you.
Yeah. Sorry for that.
Yeah, so,
Out of time.
I think we still have 10 minutes because we started 5 minutes later. But
Okay. No, thanks. No, again, I mean, thanks. I mean, all the sectors that you noted, so as Argentil, we focus on agribusiness, technology, clean energy, and consumer business. And for us, there's innovation in all those businesses. One of our recent, or a couple of investments to highlight that is, so we invested in a pharmaceutical company called Sigent Pharmaceuticals. They recently signed a joint venture with a Canadian company called ORX. Basically, what they're looking to do is repurpose existing drugs and based on the patents that ORX has developed, increase their efficacy for Africans, because the thing is that most of the drugs are based on Caucasian genomes, and the idea is to repurpose them for Africans. So that's one area where it's a traditional business, but then through biosciences, they're going to look to do innovation. We invested in a company that uses containers to build. So from a circular economy, they're reusing things and not using sort of wet construction methods, which have a higher CO2 input. They also incorporate renewable power into their buildings, so they're 100% run on buildings. So when you look at the footprint of that, from a green energy perspective, it's very, very low relative to your traditional build. And on the agri side as well, okay, we continue to support businesses that are looking to, in effect, reduce a lot of the energy costs and energy inputs that go into it. So again, for example, one of the areas we like is cold storage, where it may not make a lot of sense here, but in our part of the world where it's hot, we lose about 40% of our food, right? So having cold value chains is very important. So simple things that may not be as huge innovation-wise, but for where we're coming from and where we want to get these businesses to and the impact they can make is quite significant. Because if you're losing 40% of your food because you can't store them, if you're able to store them, then one, you reduce that loss, and you're able to sort of improve food security.
Thank you, Gabena. Imad, very briefly, maybe some words on green innovation.
For us in North Africa, I mean, the EBRD has been investing in this region since 2012. And so far, this is considered one of the greatest success stories. We've invested over 19 billion euros in this region across over 350 projects. Our projects range from supporting or investing in Africa's largest solar power plant in Benban in Egypt, to supporting SME clients in Tunisia, to investing as an LP in private equity funds that are focused on developing mid-cap companies in North Africa, including through our investments before in Mediterranean Capital and SPE Capital. So we're very excited about what the future holds for us in terms of expanding into sub-Saharan Africa, and we expect to continue using our methodology for investing in private equity to benefit the sectors that are considered core for the EBRD, including to develop the industries that are very important for us, such as green energy and digital infrastructure.
Okay, great. Thank you. Jarid?
So I'll be very short.
Last one before we open the...
Because I think my answer will be very different to my colleagues, although we've got very diverse assets. What we look for is not an innovative business. We're not looking for the next best idea. We're looking at post-acquisition, overlaying our resources, expertise, and our innovative connections to actually unlock that business. So we're not looking for the next innovation. We're looking for a sustainable business that can be scaled and replicated across multiple jurisdictions, and we kind of see it as our job as the investment manager to make sure the innovation forms part of that package.
Great, thank you, Jarid. Thanks to all panelists for their valuable insights. I think we still have about 5 minutes because we started 5 minutes later. So to the audience, if you have any questions, please go for it before they kick us out. Thank you.
Hi, everyone. Thanks for a great panel. My name is Sandra. I work at the Acumen Fund, which invests in sub-Saharan Africa as well through equity and senior secured debt and everything in between. But my question is really more about equity, because this is what the session was about, and especially equity exits, which I appreciate Gabenga touched on. That was really helpful. When we invest equity into companies, obviously there's a different strategy if you're a minority investor versus a majority investor, especially as it relates to exits. So I was wondering, for those who are investors on the panel, how can investors navigate exit challenges, especially in the cases where they're minority investors and perhaps have less influence in terms of the kind of the strategic and financial exits that you mentioned. And I think this is more of a question maybe for Gabenga and Glenn as well. Thank you.
You made it already. Thank you. You said that already.
No, thanks. Again, I think we are a significant minority investor. I think, one of the things that we look at is, one, having an alignment with the sponsor from the onset. I think that's very important. It's very important that the sponsor understands that you're there for 5 years and you need to exit. And it's very important that the sponsor also has that mindset. And even if they have a strategy of continuing the business, then maybe your exit strategy should be a secondary such that they can continue to grow. Etc. So I think that alignment is key, such that when you are looking to exit, if it's to a strategic, then the sponsor is not looking to be an issue. But if you're also helping to solve their problem, for example, if the sponsor still wants to remain in the business and you're getting a larger PE fund to come in and scale him, then that provides him with the fact that he continues to want to be in the business, but you have to exit. So that's one thing. And then also what we also sometimes do, depending on the type of investment, we put in some debt in it, because as a debt, you have senior rights. And we think that puts certain pressures on the sponsor to deliver certain milestones and KPIs that they may not necessarily look at if you only had a equity investment. So we kind of like, but for us the key thing is the alignment. That's very key. If there's no alignment, even if it's a fantastic deal, we may walk away.
Thank you, Kavina. Something to add? Yeah.
Yeah, thank you. So great question. From a neural perspective, our funds are permanent capital structures. So we typically are looking to hold on to our investments in those funds for an extended horizon. So we're not bound by like a 5-year or a 7-year or a 10-year exit on those. And then in the listed vehicle, it's very similar. So we look to integrate across ecosystems, and we're looking for interoperability in our investments before we pursue them. And it becomes part of the integral overall ecosystem. So we typically aren't going to be exiting very regularly out of Numeral, the listed entity. But to your point, though, minority investors should be starting with the end in mind when they start, and you should be building that into your minority protections in your shareholder agreements, and you should be looking at the clauses, the tag-along and come-along clauses in those agreements, preemptive rights, and obviously just be cautious from the beginning before you tie yourself up as a minority investor.
I think that's it. So if you have any more questions, I invite you to speak our panelists outside. So once again, thank you to our panelists. Thank you to AFSIC for hosting us, and to you for your participations. I hope today's discussions had shed light on the critical role of private equity in Africa, which is definitely, having like a significant growth, and there is definitely a meaningful impact for the future across the whole continent. Please enjoy the rest of the conference. Thank you.
Thanks, Najwa.